Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the Bank of England monetary policy meeting and the potential trading opportunities that will come up as a result. My name is Sasha and I'm a financial analyst from the research department at Fortrade. If you have any questions, I'll do my best to answer them, or please call us and ask to speak to an account manager. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. Now, a special code will appear on your screen during the webinar, and I will repeat this special code at the end of the webinar where you can use to take advantage of our special offer. Be aware that this offer will expire in 24 hours and that this new offer applies to all of you, not just second-time depositors. So please stick around. Make a deposit within the next 48 hours and you'll receive a balance bonus. If you deposit €1,000, you'll receive a 2% balance bonus. Deposit €2,500 and you'll receive a 4% balance bonus. Deposit $5,000 and receive a 5% balance bonus. Deposit from $5,001 to $15,000 and your overnight interest rate will be covered from 1 month. Deposit $15,001 to $25,000 and your overnight interest rate will be covered for 2 months. Deposit more than $25,000 and your interest rate will be covered for 3 months. And in case you didn't know, a market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple understand opportunity to trade in the markets. We select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so you can trade on it if you want. Market opportunities are produced by the research department on a daily basis according to market conditions and based on historical evidence. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. Here is an example of a market opportunity. You can see fundamental analysis on what's going on with the pound-dollar currency pair on the left. Below, you can see some geopolitical events that can influence the currency pair. It's important to look at the pivot point on which calculations are based. If the price reaches the level you can see on the screen, this shows the right moment in our estimation for you to come in and open a trading position if you want. You can see that this is a weekly market opportunity, although we have a regular daily trading opportunities. You can see the trend direction here, which is up. It's important that you know how to use the stop loss and take profit options. You have support and resistance levels pointed out. At these points, you can put a stop loss and take profit. Further down, you have calculations if you close the position using take profit. You can expect these kinds of profits. If the price is going against you, then you can potentially have a loss of this amount where it says support 1, 2, and 3. The pivot point is the starting position for opening a trading position. The support and resistance levels are for daily, weekly, or monthly terms. Finally, profit and loss calculations are based on a one-lot trading volume. As you can see here, I'll be talking about these topics. The Bank of England. The Bank of England is the second oldest central bank in the world and was privately owned by stockholders until nationalised in 1946. Stable prices and confidence in the currency are two main criteria set by the government of the bank. The stable prices are kept in place by the bank meeting the government's inflation target. The Bank of England was given independence from political control about 20 years ago and the right to set interest rates. We'll come back to this in a moment, since independence doesn't mean the bank won't have pressure applied by political factors. The bank became a monetary policy institute with 9 members of the Monetary Policy Committee, that's the MPC, setting interest rates. Although committee members are free to set interest rates according to their expertise, the British Treasury has reserved powers to give orders to the committee in the public interest. The 9 members are tasked with getting as close as possible to the government's inflation target. Before its independence, officials in the Treasury who were not independent of government set interest rates. The Bank of England has been accused of being politically partisan, most recently before, during and after the referendum campaign on British membership of the European Union. Bank Governor Mark Carney was criticised by politicians and the media as being biased against Brexit. He was accused of abusing his function to support the Conservative government's pro-EU position at the time to influence the referendum decision. It's true that Carney had warned that Brexit could hit the economy and cause instability, but this was not an uncommon view among economists. Carney himself rejected the accusations, saying his views represented the Bank of England and that he had not come under any pressure from politicians to support one side or the other. It's an example of how the independence of institutions can come under political pressure, and this should also be taken into account when making trading decisions. The Monetary Policy Committee. The MPC is responsible for formulating UK's monetary policy. It meets 8 times a year to decide the interest rate and to direct the government's monetary policy. The committee has 9 members, including Governor Carney. The main aim of the committee is to keep inflation close to the government's target of 2%. Apart from setting of interest rates, the other main monetary policy measure used by the bank has been quantitative easing through its asset purchase facility. In plain English, QE is the Bank of England printing money to buy government bonds. The idea is to boost the economy by increasing liquidity. In the fourth quarter of 2017, year-on-year UK GDP growth was at 5%, a figure that was slightly better than expectations, but less than the previous year-on-year GDP growth, which was 1.7%. Inflation is high at 3%, although it was in line with predictions and slightly less than December's figure of 3.1%. However, it's still far from the central bank's target of 2%. Inflation, therefore, remains a problem, which is why the Bank of England raised interest rates in November last year, and further hikes may follow. I'll return to this in a moment. The unemployment rate is currently one of the few positive indicators at 4.3%. This is close to the lowest level of unemployment in the UK for over 40 years. But there is a debate about how positive this is on the overall economy, since wage growth remains low. In January, the IMF downgraded its UK annual growth forecast for 2019 from 1.6 to 1.5%, citing concerns over Brexit uncertainty. So what can we expect from the MPC? It's widely expected that rates will remain unchanged at 0.5%. In November, the MPC voted by 7-2 to hike interest rates from 0.25% to 0.5% for the first time in more than 10 years. At the last MPC meeting on interest rates in December, members voted unanimously for interest rates to remain at their current rate of 0.5%. The bank stated that further modest increases in interest rates will likely be needed to bring down inflation. It's important to look at how many members vote in favour of a rate hike to get an idea of future likely interest rate direction. By referring to the minutes, we can also see the positions that individual MPC members hold and what was discussed. For example, it was only once the minutes for last year's June meeting was published that we found out that inflation was expected to exceed 3%. At the time, the market saw this and the MPC vote as a sign that interest rates would rise, as they did in November. Governor Carney's speeches or statements to the media are most closely watched and reacted to by the markets. In June, the bank governor stated in his Mansion House speech that now is not yet the time to start raising rates, and the value of the pound dropped to a 2-month low immediately afterward. These factors have an impact on currency pairs, particularly involving the British pound. So what happened last time? Upon the announcement that interest rates would remain the same on December the 14th, that's last meeting, we can see that the British pound US dollar currency pair fell 0.37%. The red line signifies the announcement, and you can see the immediate reaction on the graph. Markets were unimpressed by the expected interest rate freeze. However, in November, when interest rates went up, we can see that the pound-dollar currency pair dropped 1.75% in value against the dollar because the markets had already expected an interest rate hike and factored this in. But the pound fell mostly due to the fact that Governor Carney was making dovish statements following the meeting, stating that the bank was in, quote, no hurry to increase interest rates again in the near future. And the markets reacted. What are the chances of an interest rate rise in the short term? Most analysts believe that there will be 1 or 2 rate hikes this year. It's highly unlikely that we'll see an increase this month. But UBS analysts believe that the bank might raise rates to 0.75% in May, provided there is progress in Brexit negotiations. The stronger than expected GDP figures in the fourth quarter of last year supports an increase in rates. However, other economists say that low wage growth and weak consumer confidence should keep a rate rise on hold until the economic situation improves. So what does this mean for those of us that trade? Well, with the prospect of further rises in interest rates, many analysts believe the currency's post-Brexit lows are in the past. On the other hand, if there is no Brexit deal with the European Union, the value of the pound could drop again. Brexit generally remains a negative influence upon indicators and the markets. For the pound to rally, markets will need to see a concrete trade agreement with the European Union as quickly as possible. This seems unlikely in the short term. For now, the British political class doesn't have a united vision of what kind of Brexit they want. However, positive economic news for the UK in terms of economic growth and other indicators might bring forward the possible date for a rate hike, which could lead the pound to rise further in value. A higher inflation rate does put pressure on the bank to increase rates too. Analysts agree that a trade agreement with the EU is a hugely important factor to regain the confidence of the markets. In case you missed the promo code during the presentation, this is your opportunity to take advantage of our special offer, which will last for 24 hours. The promo code is FTD1X. Again, we feel that it's a great option to use our special offer on the Bank of England meeting or trade using one of our market opportunities, but the choice is yours. And of course, we at ForTrade will be following any developments that affect the markets very closely. So please do get in touch with the senior account manager if you have any questions or want to take advantage of the trading opportunities that this event will present. Until then, goodbye, and please join us again at ForTrade soon.